Good evening, everyone. I hope you all are doing good. Welcome back to the other end of the financial management series of sessions. I am Chartered Accountant Manubhav Verma, back at your service. We had a lot of fun earlier with a couple of important topics. That's cost of capital and also the investment decisions, right? So between today, Friday and Monday, so we have 3 sessions wherein we will be focusing on working capital management. This is again a very important element for every organization. We understand that being a short-term source of finance. So every organization have, from a financing perspective, right? You have discussed financing decisions. They have a long-term and a short-term source of finance. When it comes to long-term, we talk about equity and debt. But when it talks about short-term, we are looking at working capital here. So good evening, all of you. I can see a lot of messages. Kiran, Bhumika, Darshan, Rajiv. Darshan had a query on the earlier topic. Darshan, yes, if you are required to calculate IRR only with respect to the hit and trial, right? Otherwise, you have to see if there are uniform cash flows or not. Okay, so coming back to the working capital, guys. So, guys, what is working capital? Let me start the session with a very simple question to everyone. What is working capital? Let me see the responses. What is working capital? I think very basic question, but I will just talk about a little bit on this. Darshan says difference between current assets and current liabilities. Okay. Yeah, so basically, okay, I think I can see more responses coming in. Himanshu saying current assets minus current liabilities. So everyone knows what is a current, what is a working capital. Same with Dikshita, Sayed, Malay. Yeah, Malay says capital required for day-to-day activity. Absolutely perfect. See, so guys, idea is that it's a short-term source of finance, as I said. Not only that, working capital, when we say it's a current assets minus current liabilities, we also need to understand there are two terms we'll be talking about. One is gross working capital and one is net working capital. So gross working capital, when we talk about gross, that would mean only current assets. But when we say net working capital or only working capital, that means it would be a current assets minus current liabilities. Now, of course, we all understand the definition of the current assets and current liabilities. Also, we talk about that. So we look at the current assets first, right? So everyone knows the definition of current assets, right? Expected to be realized, consumed, or sold within normal operating cycle or 1 year, whichever is longer. Guys, everyone okay with the definition? I'm sure everyone knows this definition. The examples are pretty basic. You have inventory or stock, your receivables, cash and cash equivalents. I am more focusing on current liabilities. Now look at the two aspects. One way is to look at from a time period perspective that these are the liabilities which are expected to be settled in the normal operating cycle or 1 year. But look at this one, guys. Settled either by use of current assets or by creation of a new current liability. Now, what does this mean? Can anyone tell me? What does this mean? Any examples, guys? Anyone can think of? Let's see the responses. We are looking at current liabilities are those liabilities which are settled either by use of current assets or by creation of a new current liability. Okay, Himanshu says trade payables can be settled with a bill payable. Okay, perfect. Or I think Himanshu, you're paying the creditors by cash, right? Simple. But however, think where we are looking at a scenario. Okay, Varsha says, Malay says cash payment, everything. Yeah, absolutely perfect, guys. Think about a scenario where you have a short-term liability, which is being paid by taking a long-term loan. So you take a 5-year loan to pay your current liability. In that case, what will happen is, let's say my balance sheet date is on 31st March. I have paid that current liability in the month of April using proceeds from long-term loan. Ideally, I should think whether I should reclassify that current liability as a non-current, because you have actually showed an intent after the balance sheet date that okay, you are paying that using a non-current liability and not a current liability. So guys, I hope everyone okay with that example. Make sure that you know this side of the current liabilities as well. Examples, your trade payables, outstanding expenses. Now, as I already explained to you guys, we are looking at either the gross working capital, which is known as current assets, or net working capital, which is current assets minus current liabilities. But that is when you have to compute the working capital. That's why we are saying that we classify this on the basis of value. But when we have to calculate or understand the requirements of working capital with respect to time, on the basis of time, it can be defined as permanent or temporary due to fluctuation in sales volume. Now, let me give an example on this one. If you go to a showroom for, let's say, doing some shopping of garments, does it ever happen that you visit a showroom and it is half empty unless until they're shutting down? Does it ever happen that way? That it's half empty? Yes or no? Let's see the responses. I think everyone agree it will never be the case. So if I look at a showroom, it will always be stacked up. The only thing is during the season or during the sale times, you will have some extra stock, extra inventory. Yes. You will have piles up on the floor. You will have crowded store. You will have a lot of stock. You have some items on sale, some items fresh. Probably the sale items are hanging and the fresh items on the stacks. So I think that means there is a permanent working capital which stays invested for long term in the business. Imagine we also discussed something in capital budgeting, but that was a different scenario though. Now that means we are looking at a permanent working capital that stays invested in the business. Temporary is over and above that, right? Let's say your minimum working capital you need for a business is 5 lakhs. But during some months, you want a working capital of 7 lakhs. So that additional 2 lakhs would be your temporary working capital, right? So make sure we know this. And also the fact that, think about simple scenario where you're going to a restaurant, right? So restaurants also have a peak seasons and off seasons. Sometimes you have a huge crowd during the festive season, sometimes, during the weekends, during the weekdays. So you can see a lot of examples over there. Also the fact, I think in terms of financing, do you agree probably the permanent working capital could be financed by long-term sources of finance? Do you agree with me? Because it is a permanent working capital. So what we are looking at is, just give me a quick second, I'm just checking the query panel. Yeah. So what we are looking at is right now that the permanent working capital that stays invested probably should be coming in from the long-term source of finance. So if I look at a simple balance sheet, how does it look like? We have a non-current assets, we have a current assets, we have a equity, we have a non-current liabilities, and we have a current liabilities. Now, simply taken that this section is my short-term source of finance, working capital. This is long-term, and this is your fixed assets. So I would say two things. One is your non-current assets, and one is your permanent working capital. These both should be coming in by the long-term sources. That means your equity and non-current liability should be financing them. Your non-current assets and also the permanent working capital. I hope everyone is with me right now. Now, let me make you nostalgic a bit. We all remember in our schooling days, what was being taught to us as an ideal current ratio or an ideal quick ratio? What did we learn in our earlier curriculums? What should be ideal current ratio? What should be ideal quick ratio? Everyone has learned that, right? I want to hear it from you guys. Let's see your responses. Darshan says 2:1. I think everyone, Malay also 2:1. Himanshu says current ratio 2:1, quick ratio 1:1. Great. Absolutely perfect, guys. Jay, Sudhanshu, everyone perfect. Bhumika, yes. So, but in practical life, it is various factors that will decide, guys. One we have already seen, right? Seasonal nature of business. Okay, let me ask you a practical question, guys. Throughout the year, think about two outlets near your home, wherever you are living. And I'm absolutely sure that you guys can think of two outlets wherever you are, right? There must be a market nearby. So think of two outlets which are equally profitable, as in like their business is running amazingly. However, one is always stacked up with a huge working capital, and other one can actually not afford to have a working capital. You really cannot have a working capital in one outlet, or rather very basic minimal amount. So can you give me an example of two outlets, guys? Think about any two shops which are very much profitable. One requires a huge working capital, one doesn't. Think practical examples these are. So let's see who comes up with the first one though. Two examples, guys. Two names of any two outlets. I hope you are thinking and responding. Okay, let's see who is the one to respond first. I guess I'm not seeing any responses yet, maybe. Okay, give me a second. I'm just refreshing the query panel. Let's see. Okay, so what I'm getting is here. First answer was from Bhumika, retail stores and small barber shop. Amazing, good example. Service, wow. Malay says huge working capital grocery store. Bata, I think Darshan, I love your example. Darshan, this is my favorite one, like Bata showroom and a Domino's pizza outlet, grocery or a garment shop and vegetable fruit shop. Perfect, Yashika. Yashika is also giving perfect response. So guys, yeah, so I think broadly the two examples I always take in my lectures is like, Domino's and a pharmacy. And I think most of you have given amazing examples. So good round of applause for all of you. So we are looking at, again, think about a restaurant, Domino's, a pizza outlet. Can they really stack up working capital? Can they have a lot of pizza bases? They're perishable, right? The products are perishable. You cannot afford to have. Whereas a grocery store or a pharmacy cannot afford to have a less working capital, less inventory. Because think about, Himanshu, perfect. Rajiv, absolutely perfect. So idea is that, you are talking about a scenario where you cannot afford to have a less working capital, whereas, the customers are coming and you're saying that, sorry, sir, we do not have the stock. It may happen once, it may happen twice, but if it happens regularly, then customer will not come back to you. Okay. Okay, great. So that means what we understand is the optimum level is actually depending on a lot of factors, whether it is a current ratio or it is a quick ratio, right? Now, one thing is also sure that it is the working capital investment also have an opportunity cost, because if you are talking about both the sides, you have an extra investment than required, you end up incurring an opportunity cost. If you have a lesser investment in working capital, then probably you will lose the customer. So we talk about types of working capital on the graphical mode, you can see, I think on the first left-hand side, you can see the difference wherein we have a permanent working capital and then there is a, a temporary working capital going up and down depending on the season. So these could be seasonal fluctuations. And on the right hand side, you can see that let's say we're talking about a growing organization where your permanent working capital is also increasing as you are growing over the period of time. Probably, at some stage it will, further flatter and flatter, right? Okay, so what is the significance of working capital? We know this already, that need to have sufficient liquidity to ensure that the business is survived. Now, I have a question here to everyone. And you just need to respond by true or false. The question is, a profitable business, a highly profitable business can be forced to shut down if they're not managing their cash, and a loss-making business can survive for years if they are managing their payables. What do you think, guys? Is it true or false? Let me see the responses here. True or false? I think everyone unanimously saying it's true, right? It's true. So just having profits and having liquidity are two different things, right? So that means we need to have sufficient liquidity to ensure the survival. And also, when you're talking about the investment business, that's what we discussed, capital investing. We should be actually considering not only the initial outflow, but also the timings, what will be the additional working capital, when will be the returns, how much will be the returns. So that means, for example, talk about additional project where increased production is anticipated. This will be definitely requiring more working capital, more inventory. And when you're looking at increased sales, again, your inventory would be required. And also if you are increasing in overall size, scale of the organization. So we will actually talk about a very, very important slide now, which is looking on the liquidity or profitability balance. But before that, let me just kindly quickly recapitulate what are the different factors we are being talking about in the last 15 minutes, which decides my optimum working capital. By now, everyone understands and agree with me that okay, 2:1 is a decent current ratio we learned, but probably that's not the defined rule. So what are the factors here? So the factors here are, we are looking at nature of business. That's what we discussed just now. Type of products, again, coming in from the first point. Operating efficiency. So let's say you are talking about highly efficient. We'll talk about, for example, in inventory management, we'll talk about just in time. Then obviously the inventory requirements may be less. Then we are talking about credit policies. So if you're relaxing the credit policies, that means there will be huge pile up in the debtors. Cash holding requirements like minimum balances from bank. Price level changes. Now, price level changes, of course, with inflation, of course, you would need to maintain the same purchasing power. You need to make the a larger investment in working capital, very logical. Short-term financing options. So less options, probably more working capital you need. More financing options are available, you may not worry about. Similarly, market and demand conditions. If you're talking about demand is more than the production again, then we are looking at less inventory. Of course, there is a scenario we have to cover it up by making more production here. Then manufacturing policies. I think this is very, very self-explanatory. Steady production or seasonal. Now, if you're talking about a seasonal demand, of course, you have to scale up, probably operate in a double shift. Credit policy I already talked about. So these are the various factors which will determine that what would be an ideal working capital, guys. Now, any questions on this particular slide, guys, on these points? Any questions so far? Let me quickly check the query panel. Any questions from anyone, guys, on the determinants of working capital? Okay, great. Now, this is very, very important. We are looking at three economies here. That is economy in financing, efficiency in utilization, and effectiveness in achieving the intended objective. So 3 E's. We're looking at 3 E's. Economies financing means probably low cost of capital, efficiency in utilization. Again, we are looking at optimum utilization of resources and effectiveness. So efficiency generally is, how the resources are utilized, and effectiveness is with respect to what is the objective and is it actually being achieved. Dikshita says, sir, please explain the credit policy again. Dikshita, if I relax the credit policy, okay, I will talk about this little later, in very detail. But if I want to increase the credit term to my debtors, do you agree that there will be increase in the debtors? So let's say I have a current credit policy of 30 days, but I increase into 45 days. So then my debtors due or the receivables from the customers will be increasing, and hence working capital will go up. So lenient credit policy we are talking about in that case, and vice versa. Okay, so guys, working capital management, we are looking at 3 E's here: economy in financing, efficiency in utilization, and effectiveness in achieving the intended objectives. As I said, economy, financing, we are looking at low cost. We're talking about how the utilization, the resources are utilized, and also whether the organization is meeting their objectives or not. Now, there is a trade-off generally, which is required for every organization, and that trade-off is required between two important elements, that is profitability and liquidity, guys. Obviously, every organization would want how can they increase the profitability without impacting their liquidity. That would be their objective, right? Optimum objective. So let's see different working capital components right now. And let's say what will be an advantage or disadvantage of keeping a higher level versus lower level, guys. So guys, let's say if I keep higher inventory, what are we saying here? Higher inventory. What would be a disadvantage? Higher inventory. What could be a disadvantage of higher? Advantage is okay, that you have a lot of stock, lot of varieties, fewer stockouts, more sales. The fewer stockouts will more sales, but there could be negatives also, right? Opportunity cost. There could be what else? Perishable in the case of products which are perishable. It could be perishable, obsolescence. Now, if we keep a lower inventory, look at the right hand side. Lower inventory means your less money is stuck, right? Requires less capital. That means there is no opportunity cost. But the problem is of a stock out and loss of reputation. Stock out means that customer comes to you, ask for a product, and you do not have the stock. So that means what we are looking of is we're stuck, right? Should we keep a higher inventory? Should we keep a lower inventory? And the idea is to get a good trade-off, a balance between the two. And that balance is, kind of created with a lot of working capital management techniques, including inventory management, of course. And we will talk about that a little later. And I'm sure you guys have already studied in as costing as well, where you were talking about economic order quantity, just-in-time inventory. So all this is definitely helping you to bring in the efficiencies in the processes, and hence we are looking at optimum level, striking at an optimum level. Yashika says chances of more risk by human and natural factors also leads. Yes, absolutely, Yashika. Very good point. So Yashika says that okay, if there is a process, manufacturing process, or because of the natural factors, it could be resulting in more wastage. So again, a trade-off, guys. Moving on to the next factor, receivables. I think Dikshita, you were talking about that, right? The credit policy. We are talking about receivables all over again. Karthik says obsolescence risk, large amount of funds get blocked if more inventory is kept. Absolutely correct, Karthik. Now we talk about receivables. Receivables, or better known as from our schooling days, Sundari debtors, not Sundari, but sundry debtors, right? This is what we had studied earlier. Now let's talk about a higher level or lower level. First, let me talk about a lower level. Now, lower level of receivables means I have a stricter credit policy. I'm asking my customers to pay me early. Instead of 30 days now, guys, pay me in 15 days. That means a little bit of an advantage would be in a more cash sales, early collection, but there is a negativity also. It fails to boost revenue because if let's say a competitor is offering 30 days, your customers may go to the other vendors, because you are being aggressive. Lower level of receivable means a stricter credit term. You want money to be collected earlier. What about the higher level, guys? Now, obviously, the higher credit period means or a lenient credit policy means customers are happy babies. And when they are happy, they will come to you. Sales will increase. Definitely sales will increase, right? More sales. But there is a negative element also. What about bad debts? Collectability could be an option here. Could be a big problem. What about bad debts? Hence, again, the trade-off should be you have to decide internally what kind of credit policy you need to decide. You want to be making it too lenient, or you do not want to make it too too kind of relaxed. Probably you want to decide somewhere in between. So you have to evaluate the which credit policy is best. And mind you, we will talk about that. Evaluation of credit policy, something we'll be discussing for sure. This is something we will talk about separately, evaluating the credit policy. Now they're also giving you some other options here, right? For managing the receivables, probably you can also use factoring, or you're looking at from a perspective of selling of your receivables, right? You're looking at factoring, or in that case, we'll be talking about factoring with recourse or without recourse. We'll talk about that a little later. That means you are getting rid of your receivables by selling them to someone, and you're getting the collections earlier. Now, whether you should opt for factoring or not, that is also we'll be discussing separately, right? Guys, any doubt so far in inventory and receivables, please? Inventory and receivables, any doubt? Any doubt so far from anyone? Okay, great. Thanks for confirmation, guys. Looking to the third point, cash and cash equivalents. Now, if you are looking at a higher balance of cash and cash equivalents, your payables, your creditors will be happy. You will be able to pay them in time. Goodwill will be better. But the problem is lost opportunity, or you're talking about interest cost, lost interest. Because you're keeping cash, probably you will lose the interest. Now, if we are talking about a lower level of cash means that you could invest in other venues, surplus cash. So let's say the treasury team, which we'll talk about later also, the role of treasury functions. So treasury team license with the other departments with a collection and payment forecasting to be pretty accurate. What they will do is, we'll talk about this in cash budgeting, where they would know, okay, when is the cash required, till what time it is surplus. And I imagine while I was working in one of the corporates, I was sitting next to the treasury team. One day I heard they were negotiating the rate of interest with the banker over the call for a fixed deposit for 6 days. I mean, 6 days, really? I think those of you who have seen fixed deposit, your parents make fixed deposits, we talk about 6 years, right? We talk about 6 years max, at least you could talk about 6 months, but who talks about 6 days? They talk about 6 days fixed deposit. But imagine, let's say the negotiate a rate of, let's say the company has excess funds. Just taking an example. Let's say the excess funds, the company has a 10 crores. So if 10 crore is there, so in that case, let me take that example on the top. So you have 10 crore free available for 6 days. And the company can negotiate with the bank for making an FD for 6%. Can anyone tell me what would be the interest company will earn? 6%. I think close to 9,800, close to 10,000. The company is having 30 crores. Imagine the company has having a 30 crores here. So 30 crores will yield to almost an interest cost of 29 to 30,000. If invested. Okay, so it says 98,630. Yes, can you just double check the calculation? I can just double check. What is the calculation coming on? 98,630. Okay. Okay, I think there is a 10 is a problem. Let me correct that. So that means if we are looking at, if we are talking about 10 crores, we are looking at almost 1 lakh. And if you're looking at 30 crores, that means 3 lakhs. Can I say that? Everyone okay here? Almost 2,95,000. Now that means whatever, guys, I think you guys can check the calculation part a little later. See, what I'm trying to prove here is, give me a second. Yeah. What I'm trying to say here is that for investing that extra surplus for 6 days, imagine a lot of payroll can be handled. A lot of expenses can be met, yes or no? If you have 10 crores, 30 crores, you have 1 lakh, 3 lakh surplus funds. So you're talking about like additional interest you will earn, right? Guys, everyone okay? And hence, role of Treasury Department in licensing the payments and the collections becomes very, very important. Hence, you could invest in other revenue. So that's an advantage of a lower liquidity. The only problem is you have to be very, very careful in terms of the marketability. As in, you should be able to liquidify your investment when it is required. If your money is stuck and you cannot liquidify, then you have a problem in your hand. Yeah, that's why we say that, okay, do not invest in real estate for the funds that you may need. Yeah, that's what it is. Now, how do you make a balance between profitability and liquidity? That is what I'm explaining currently, and we'll talk about that using the budgets later on. Okay, moving on to the next element. The next element is prepayments, guys. I think prepayments is okay. So anyways, required in part and parcel of the operating cycle. That generally, if you have inflation times, you will have a advantage in inflation because you would have already paid at an older cost. Think about insurance premiums. Anyone who took a policy before March 2020 had taken a policy with very, very less, I think significantly less cost than what it is now because of the pandemic and also inflation, other factors coming in. So prepayments, payables, now payables, right? So can you keep a higher payables? Again, as long as you within the credit limit provided by your vendors. So if you can afford to have a higher payables, then obviously your funds can be invested, like I told you, in FD. And but if you are talking about lower level of payables, that means it is probable that you are making the payments in time. It is improving your image. And here we will talking about how do we evaluate the credit policy given by the vendors. So a good slide here, wherein we are looking at trade-off between profitability and liquidity. However, this entire discussion is based on the working capital requirements on these two factors. There could be also a scenario where working capital requirement can be based on investment and financing decisions as well. Now, based on the investment and financing, we are looking at two factors: investment, basically how much is needed; financing, where it will come from. That's what we are looking at. How much and where it will come from. Again, as I said, permanent working capital, temporary working capital, you want a permanent working capital to be financed by your debt and equity, long-term financing. Now, How much depends on the policy, right? You can see three policies on your screen right now: aggressive, moderate, and conservative. Now, aggressive means probably you are talking about less working capital, guys, not more. Aggressive means less. That means you are so confident in your processes that, okay, you're fine to keep a lower working cap. Hey, I'm fine with a 2 lakhs of stock. I'm pretty confident that my vendors will deliver that in time. So what we're called aggressive. Aggressive means lower levels. That means less inventory. Strict credit policy. Hey guys, pay me earlier. That means in that case, your current assets upon fixed ratio would be definitely lower because you will keep a lower current assets. Positive, of course, it's a less investment, but negative could be a less growth in the aggressive policy. On the other side, if you look at conservative, that means we are pretty much not sure of our processes, guys. We are not sure. We are very much scared. Higher levels. Okay, let me ask this question. By nature, most of us are more of a conservative, right? Let me give you examples. Before that, Yashika has a point. Lower prepayment can also be presumed as negatively. They were not. Yes, absolutely, Yashika. Perfect. Yashika coming in with good, solid interpretations. Again, the assumption you mentioned should be justified, right? So that's okay. Okay, so coming in from a conservative, right, higher levels of working capital. So here, can anyone give me an example of your day-to-day lives where you are conservative and you keep some cushion? I have some solid examples. I'm sure many of you, if you have to be waking up early in the morning to catch a flight or join a lecture or whatever, you have to be ready by 7. You might be keeping at least 2 or 3 alarms. Am I correct? How many of you probably in your wallet now? I think right now it is a time of digital money, but before COVID, when there was not much of a PTM and digital money being used, many people, you can ask your elder siblings and parents, they used to keep some emergency money at home, right? Everyone agree with that? That kind of a cushion was always there. And that means we have been a little conservative by nature. Imagine that you have to catch a flight in the morning at 9 and you are just keeping one alarm of 5. You're aggressive. You are sure that you will wake up. You are sure you will wake up. So higher levels, conservative means higher level of working capital. That means you want more inventory. You are not sure of any kind of inventory management techniques. And then liberal credit policies. And hence your current assets will be higher. And hence the current assets upon fixed asset ratio will be higher here. Now the positive, of course, that means you're giving a relaxed credit policy. Customers are happy. Higher inventory that will lead to growth in sales. Negative is higher risk of bad debts and opportunity cost because your inventory is stuck. Darshan keeps 3 alarms. Anyone who keep more than 3 alarms? That's okay. Okay, I think another example is when you're going to a function as a family. How many of you come back and check your door handle, and sometimes you press it too much that it may come in hand, right? You want to double check whether it is locked or not. I'm sure many of you would have done that, right? So talking about conservatism here. Or lack of confidence, you may say, right? Rajiv says before demonetization, people used to keep money in their piggy banks. Yes. So Rajiv, again, piggy banks, hello, yeah, whatever you're talking about in terms of your wallets, right? In terms of wallets, behind that photo or your religious photo or whatever, you would keep some currency. By the way, you mentioned the demonetization and everyone is kind of becoming a little crazy here and there with the 2000 note news coming up, right? So anyways, so right in center, we are looking at a moderate working capital policies, neither aggressive nor conservative. Of course, it balances the risk and return. As I said, profitability and liquidity. It has to focus on efficient use of funds. That is why it is called as a midway approach. I think many companies would want to follow a moderate approach. Shubham says, yes, like alarm with a 5 minutes each. Yes, Shubham. Because you don't know in the sleep whether you are snoozing it or stopping it. Himanshu says when I go to new places, I go at least 30 minutes before. Absolutely. So I think later on, guys, if you guys are going for an interview, of course, I normally, when I remember my interview days, I used to make a target like if my interview has to be at 11, I have to reach it by 10:15, 10:30 at max. 45 minutes margin I used to take. It's always good, right? It's always good. Anyways, look at this particular graph, guys. Everyone, I think this graph is self-explanatory. Yes or no? Conservative, the highest level of working capital. Average is where you want to be. Aggressive is very close to the, your fixed asset investment. That is your probably a very slightly tight position. Most of the companies would like to be over here. As I explained. Okay. Moving ahead, guys, we look at a very interesting ratio I was talking about earlier in the, your policy, aggressive, conservative, or moderate. That was current assets to fixed assets. Now, we're talking about optimum level of current assets. The idea is to maximize the shareholders' wealth. And we know that as the company expands, the current assets will be required. The only thing is that it should not be required in the same proportion. Why? Because you would expect your operations to be efficient enough. And hence we say the current assets requirement can increase, but at a decreasing rate. Bhumika says aggressive working capital means low. Conservative means high. And moderate means yes. Bhumika absolutely correct, but I think there was a typo in conservative. I guess you wanted to say high, right? Your understanding is correct. Aggressive means low, conservative means high, and moderate would be somewhere middle. Okay. So coming back to your ratio, right? So we are talking about that, okay, with the expansion, more working capital would be required, but whether the current assets should be rated in the same rate? No. So that means what we're looking at is that we are expecting it to be an efficiently operating organization. Now, of course, this ratio, if it is higher, that means you are keeping a higher working capital. Higher current assets, higher ratio, current assets to fixed assets. Conservative policy because you're looking at a higher working capital. But if you're talking about lower ratio, that means it's an aggressive policy. But the interesting factor is that it has inverse relationship generally with return on assets. Let's see that return on assets. So guys, I've seen ratios, I believe. So you're looking at 3 scenarios on your screen: EBIT, current assets, fixed assets, and total assets. So return on total assets is EBIT upon total assets. So you can see a scenario where you're looking at same level of EBIT with 3 different levels of total assets, where in current assets is the one which is changing. So probably we can go to, from left to right, where we're looking at, okay, current assets requirement is probably decreasing. Now, obviously the return on assets will go up, but your current assets upon fixed asset ratio will go down. So that's why it's an inverse relationship, guys. So you may get a MCQ or so on this, just that you should be aware with the relationship. Okay. Moving ahead, now we talk about the first important aspect here. Working capital, guys. I'm sure you have been talking about this in the ratios also, turnover ratio, right? What is the turnover ratio, right? Inventory turnover, receivables turnover. We call it as turn it over, right? We kind of rotate our working capital so many number of times that you would like to utilize your churn your resources so well that they can rotate larger number of times in a year. Now let me ask this question, guys. If we look at working capital cycle, or also known as operating cycle, which is actually the length of time between the companies paying the goods for materials, entering into stock and receiving the cash from sales of finished goods. It's end-to-end operating cycle. My question is, would you want operating cycle would be more or less for the organization? Yashika has some points. Conservative organizations have low financial leverage, reduce. So Yashika, absolutely. So then they cannot magnify their potential for growth. Absolutely perfect. That's anyways the advantage of Rather I would say disadvantage where you go for a conservative. Okay, so financial leverage has an advantage and you're missing that. Good interpretations coming up from Yoshika. Himanshu says less. Everyone else, guys, you want a longer operating cycle or a shorter? Longer operating cycle or a shorter? Okay, so Himanshu says more, Shubham says longer, Sayed, Gudri, everyone saying less. So we have mixed response. Okay, guys, think about. I enter into the market, I purchase some raw materials, then I went for the production, then I sell my finished goods, and then I recover. Why would you want this entire stretch to be longer? Those of you are answering me longer. I think you would want your money to be coming back to you as quickly as possible, yes or no? That's okay. We are not talking about right now the balance. We have talked about that moderate. It should be neither more or neither higher or longer or neither shorter. That's okay. But I guess as a preference, you would like to have a shorter, right? As a preference, if compared with a longer cycle. Because if working capital is longer, of course you would need more funds to be blocked for a longer period of time. Absolutely perfect, guys. So Varsha mentioned that point. Now that means if we kind of summarize, operating cycle is a total of. So see, also one point is we are looking at shorter the cycle. It would mean more number of operating cycles in a year. That means your resources can be utilized more number of times. Your money can grow exponentially, right? So that means operating cycle is total of these raw material storage. Then production starts, so your work in progress holding period. Then finished goods are produced, but they are not sold immediately. So finished goods storage period. When you sell them, your debtors will take some time. So debtors collection period, that your credit policy. And similarly, the raw materials you purchased, the creditors would have given you some time. So that will be reduced. So reducing that element that gives you your operating cycle. Everyone okay, guys, now? I hope this is going good. Okay, so let's see a quick example here. So Dhoni and company, I know everyone is getting nostalgic with Chennai Super Kings entering into yet another final. Many Dhoni fans here. So Dhoni and company holds raw materials on average for 45 days. It gets credit from the supplier for 30 days. Production proceeds 25. So what are we looking at? Raw material storage 45. Production needs a process that is 25 days. That is WIP. 45 plus 25 is you're looking at a 70. Finished goods 15, 85. And then you're looking at a credit allowed to the debtors 85 plus 45, 130. But from 130, we reduce this 30 and we get an operating cycle of 100 days here. Guys, everyone okay here with this quick example? But we will now also learn that how to calculate these number of days. Don't worry. Okay, so I think whatever we have discussed now kind of summarized in the next slide. Everyone understands time is money. Why won't you collect your money tomorrow but today, right? If you were to if I were to owe you a couple of $1,000, you would want today rather than tomorrow, right? So that means if you look at this relationship, if and then, if you collect your debtors faster, you release cash from the cycle. If you collect the receivables slower, you are having your funds blocked. Darshan says, can you explain the deduction of credit period one, sir? Darshan, that credit period which we are reducing is on the purchases. So when we are allowing the credit period to our customers, we are also customers to someone, right? Your creditors would allow you some time to make the payment. You would have done purchases from Darshan. Make sense? And that is why if you're adding the entire cycle, that period needs to be reduced. Because that's a benefit. That's the number of days you're saving on. Okay, let me also give you another perspective here. Let's say I draw a number line in which this much is my raw material storage period. This much is my production. This is my finished goods storage period. And let's say this is my debtors collection period. Now, Darshan, in that number line, let's say this was 45 days. Within this 45, there is some time you are also getting, which I'm highlighting with a green line on the top. Let's say within this 45 days, 30 days is given by your supplier. So I have included 45. Either I should have included only a 15, additional 15, right? You are storing the raw material for 45 days. Don't take 45 then, only take 15 because your creditors are also giving you 30 days. Darshan, are you getting it now? But since you included entire 45, we will eliminate that 30 later on. Everyone else is okay, guys? Just quickly checking the query panel here. Great. Okay, so this is again a summary of what we have done so far. We're looking at either consequences of a quicker collection or a lower collection or your higher inventory or a lower inventory. So that's okay. That's self-explanatory. Now it's a time for calculating the operating or working capital cycle. You will see a lot of formulas here. Trust me, you may think that, okay, oh, this is so much formula. How do we remember? But trust me, you really do not need to. My own opinion is you do not need to rectify these formulas if you understand this properly. So let's say raw material storage period. Okay, we are calculating this as number of days, right? Everyone knows this, right? We are looking at number of days. If I look at raw material storage period formula, you look at average stock of raw material, that would be in rupees. And average cost of raw material consumption per day. Again, this is also rupees. So what is my stock, average stock of raw material? And what is the consumption per day? So if I divide that by, okay, so what would be that meaning? That means I'm getting a raw material storage period, because if I expand on my numerator, what will that be? Probably days into number of days into average raw material cost per day. And we divide that by the average raw material cost per day. Hence, this gets knocked off. You'll get number of days. Is everyone getting the logic behind the formula? Yes. So Yashika has a valid point. Yashika, I was actually coming to that after this, but that you could also remember your turnover ratios, right? Where a number of days of inventory was 360 upon inventory turnover ratio, right? Am I correct? Yashika, I hope you're talking about that only. Your receivables turnover ratio. Number of days of receivables, 360 upon average, or 360 upon receivables turnover ratio. But what about others? Yashika, that's okay. So some of the ratios you can use, but others, right? Work in progress holding period. Look at that. Work in progress holding period, WIP. So here you use the same logic, average work in progress inventory, because see, for a manufacturer, we are looking at three types of inventory: raw material, WIP, and finished goods. So work in progress holding period is also required. Na? So average work in progress inventory upon average cost of production per day will get your production cycle. Similarly, finished goods. So all these are the formulas which need not to be mugged up, but rather understood properly. Look at the receivables collection period, guys. Average receivables upon average credit sales per day. So what would be the average receivables? Again, same logic, number of days multiplied by the credit sales per day. And that's the denominator. So I can knock these off with each other. Guys, I hope everyone is okay here. So basically, I'm explaining you that, once you understand these formula, that should be okay for you guys. And also the fact that given information of the question will help you. Given information in the question will help you to understand this better. So let me take an example of an illustration here. On your screen, guys, I want everyone to participate now. Calculate the net operating cycle and number of operating cycles. This is interesting. So that's why you wanted a shorter operating cycle, because you want to have a more number of operating cycles in a year. So raw material inventory consumed during the year, guys. They have given you that average stock is given. So how much will be the raw material storage days? If you look at the formula, average stock upon average cost per day. But mind you, they have not given you the per day, but they have given you the cost of inventory consumed during the year. We can use 360 days to calculate per day, guys. Average receivables is not number of days. There, what we are looking at is, average receivables is the average receivables in rupees. Sayed, I have just broken that into two. Number of days into credit sales would be average receivables. Average receivables is the amount. For how many days your receivables are pending. So credit sales per day into number of days will be your average receivables. So now in this case, inventory consumed during the year. So let's say we calculate per day. So 12 lakhs. How much are we getting? 333. And then we get a operating cycle here. So raw material storage day would be how much? We are looking at average stock 100,000. That is 1 lakh divided by. Are we getting 30 days here for raw material storage? Next, looking for a WIP. They're given a production for the year. They're giving you average work in progress inventory. So what is my per day production? Because what we are looking at is average cost of production, so per day. So 10 lakh divided by 360. I think we're getting at 277.78. So what is W then? So your average work in progress is 50,000 divided by 277.777. You're getting 18 days here. Everyone getting WIP storage period is 18 days. Rajiv, just check, it cannot be 180, it has to be 18. Okay, I think everyone is confirming me that it is 18 days. Okay, then the next point is, after we calculate that, we need to have a finished goods storage period, right? And with finished goods, they've given us average, cost of goods sold during the year. And we look at the formula here, average stock of finished goods upon average cost of goods per day, right? So we again divide this by 360. So we are getting 4 times 4. And hence we get a debtors period or a finished goods period, not debtors right now. So how much we're getting for finished goods, guys? 80,000 divided by 444. think you're getting another 18 days here. Everyone okay, guys? What we're dividing here is like average stock. We're dividing at the per day. So all these should be self-explanatory now. So for the operating cycle, we have our R plus W 18 plus finished goods 80, and the collection period from debtors is given to us thankfully plus 45 and minus the credit period availed. Now this is 30 days. So how much are we getting here? We're getting 81 days here. Can anyone check and confirm? Guys, everyone with the 81 days operating cycle, please let me know. How did we get 30 days? So Danshu says, how did we get 30 days? Danshu, because they were you're asking raw material storage, right? They were giving you raw material inventory consumed during the year. So daily inventory raw material to be consumed is 3,333.33. An average stock you are holding is 1 lakhs. On an average, you are getting 1 lakh. So 1 lakh divided by 33333.3. So you calculate 3333.3 and 1 lakh is divided by that number. So that's how you get 30. Himanshu, I hope it is clear now. Not Himanshu actually. This was Sudhanshu actually. Sorry. Sudhanshu, is it clear? I think Himanshu confirmed it is 81 days. Great. Barsha, Bhumika, all have confirmed. Okay, so guys, if my operating cycle is 81 days, how many number of operating cycles we can have? We have 360 days and one operating cycle is 81 days. So 360 divided by 81 is 4.44. Now, interestingly, shorter the number of, shorter the operating cycle, more the number of cycles in a year. I think this is now clear basically with this particular example, because my denominator is operating cycle. So let's say my operating cycle is 60 days. Then the answer would have been 360 upon 60. Guys, I hope this is clear to everyone. For any doubts, you guys can have a quick look at the solution here. I'm giving you 1 minute for this. Just giving everyone 1 minute. Now, very interestingly, I think one thing I'd like to talk about here is, till now, if we have understood, okay, how do we calculate the working capital of an organization? You would give me an answer, current boss, बहुत simple है. Current assets minus current liabilities. Why are we even asking this? But guys, what if you have to estimate the working capital requirements? What if they give you each and every components? Okay, this much of production is happening. This is the raw material you would be needing. This many months of expenses are outstanding. This much is a credit period for the debtors. So you have to calculate each and every component of working capital, guys. Till now, working capital was a cup of tea for us. How many of you agree with me on this? Working capital, liquid the balance sheet. Do current assets minus current liability. That's working capital. But boss, we are not asking you the historical working capital. We are asking you if organization has to plan their working capital requirements. They would probably require your help to get hold of some requirements in terms of individual components. What is the raw material you need? What is so inventory takes care of 3 items, right? Yashika says, what if the cost of production per year isn't given? Yashika, if one thing is not given, other thing would be given. So don't worry about that. You have some parameter at least to get you to the to the bar. Okay. Okay, so yeah, I was talking about the working capital. Till now, we have been just calculating, okay, working capital is current assets minus current liabilities, but here we are estimating the current, current assets and current liabilities. Look at these formulas again. Okay, you might be wondering right now, oh gosh, again some formulas. But guys, you really understand, please. These formulas, if understood, will relieve you from rectification and rather more of an understanding. So even in operating cycle, if you think, number of inventory, number of days of raw material I need to hold. Think logically, na? Number of days, kitne din ke liye, how many days of inventory I need to hold. So what I need to do is probably I would need a, maybe a raw material requirement of a daily basis. And I might need, okay, how much stock I need to keep. So if I divide those two numbers, I will get number of days of inventory. So think logically. Similarly, for working capital, you will see there are so many formulas on the screen, but trust me, this is not absolutely burdensome. So let's look at how much is a raw material inventory you need to calculate. Raw material inventory. Without even formula, raw material inventory would be dependent on the production, guys. Yes or no? How much production you need to do? And then probably what is the number of days you need to store the raw material for? Coming in from operating cycle, yes or no? Two major things you need for understanding raw material inventory. What is my production requirement? And what is the number of days of stock I need to keep? Because you'll multiply with that number of days. Yes or no? Everyone okay here? Let me double check. So what we need to understand is what is my production and what is the number of days of inventory we need. That's it. So look at the formula now. Estimate production. That's what you said. Okay, you need that. But that estimate production could be your total production for the year. That's why we are dividing it for 12 months or 365 days. We are multiplying that estimated cost per unit to get the amount. And that is multiplied because this gives you per day. This gives you per day inventory. That is multiplied by your average raw material storage per period. So let's say you want to have a raw material for 30 days multiplied by 30. I think it's absolutely not at all a challenge to know these formulas. These are not formulas, these are logics. How many of you agree with me on this? Raw material inventory, right? You need a production, you need a what is my cost per unit. So what will happen is, let's say if I am making this pen's total cost is 10, but in that 10 raw material is only 2 rupees. So I will multiply the total production required per day production into 2 rupees into number of days of inventory I need. As simple. Right? Let's go to the work in progress inventory. Similar logic. Your production per day, this gives you the production per day. Then you multiply that estimated WIP cost per unit, which will give you per day WIP cost, and that multiplied with the average holding period coming in from operating cycle. Mind you, the number of days will be given to you, or you can say they are coming from the operating cycle calculation, which we already understood. So same with finished goods, but I would like to talk about this a little bit. Let me just use a different color pen, and we will see a lot of practice today on this and of course on Friday as well. When we are looking at estimated cost per unit here, we are looking at estimated WIP cost per unit here, and we are looking estimated cost of production per unit here. Can you see the difference? In the first, we are only talking about raw material cost per unit. Here it could be a WIP. That means there could be a direct material or a labor plus expenses. That's a WIP. And then finished goods. This is your total cost of production. Material, labor, and overhead combined. So remember that what cost you need to use for finished goods, you're talking about cost of production. Everyone okay, guys? The only thing is, I will also explain you this cost of production concept in a while, because once we move to the debtors, look at what we are doing. Estimated credit sales divided by 12 months, so per day sales, multiplying the cost of sales excluding depreciation per unit. We actually use cash cost of sales. Cash cost of sales, guys. Why we are using cash cost of sales? Let me tell you. And that is also the pattern we follow for the finished goods. Why I'm using the cash cost? One is that we are excluding the depreciation because it is a sunk cost. Yes or no? The non-cash cost. Second, why we are considering cost for debtors, guys? Let's say if I'm making a sales of 1 lakh to debtors, those debtors are still receivable. Is my working capital, like in financial terms, you calculate debtors or working capital, may you look at the balance sheet and you took the debtors, right? That's what you do. Yes or no? When you are looking at the financial statements, you just straight away take the receivables and you calculate the working capital. That's a historical analysis. But when we have to anticipate my working capital requirement, think logically. If I'm anticipating 2 lakhs of debtors, 2 lakhs of debtors which are yet to pay, do you agree that 2 lakhs would also include an element of profit, which is not my cost? Of course, that is over and above the cost. That means if I have to understand, why do we exclude profit? When we talk about cost is considered and also cash cost is considered. That means we are excluding profit also. The word is cost. Because profit is not, so excluding profits, because profit is not invested from your side. This is additional amount you're recovering from the receivables. What we are calculating is what is your funds blocked in the business on the on the context of working capital. So in debtors, your funds which are stuck for collectibility is the cash cost of sales and not the selling price. So not selling price, please. We are using cash cost, not selling price. I want everyone to give a confirmation that did you understand this? It's a very, very important point. Everyone okay with the debtors that you're not including the selling price? So let's say if there is a product which is sold for 10 rupees, the cost is 7. And let's say all this is cash cost. So we use 7 and not 10. Okay, so I think I got some positive responses from many students. Great, thanks for confirming, guys. Good to always know that. Okay, Darshan says, can you please summarize once again? Darshan, why not? Darshan, my point is, if you're selling a particular commodity, let's say this pen is sold for 10 rupees. And I say that, okay, debtors worth 50,000 are yet to pay me. That 50,000 will also include a profit element, right? So whether my working capital is stuck in the business to an extent of 50,000, no, 50,000 is a selling price. So that mine is profit. So my working capital is required only to the extent of cost. I know this is something which is not as per what we do in the financial analysis term. That's a different ball game. When we calculate current ratios, we calculate working capital for historical analysis. There we use the entire data in the balance sheet. But here we are anticipating. We are basically calculating the working capital requirement. Right? Darshan says the cost of finished goods also include cost of raw material and WA. Okay. So Darshan, there are 3 types of inventory, right? Raw material only. So you will have all the 3 types of inventory, mind you. So raw material bhi hoga, WIP will also be there, finished goods also be there. But finished goods will have those raw material which are already converted into finished goods. So yes, it will include raw materials and WIP which is already converted. They are no longer raw material or WIP now. That's why we are calling it finished goods. I think your question itself has a you have to rephrase your question. How come finished goods? So finished goods may raw material and WIP are converted to finished goods, but to make a finished good, you will use raw material, labor, and everything, right? Cost of production. Raw material, labor, and overhead. So that is the cost of production, but that is finished goods. Everyone else doing good? Yashika, Bhumika, Himanshu, all doing good, guys. I think some of you already confirmed. Manisha, Syed, great. Okay, moving on to the cash and cash equivalents, guys. Now that is something which is generally given to us. You know, how much is the minimum balance company needs to keep, minimum cash balance. So this left hand side takes care of the current assets, and the right hand side we are looking at trade payables. Now look at the formula again. Trade payables, how much money you need to pay to your creditors at the end of the day, like in terms of working capital, how much time they're giving you. So estimated credit purchase you divide by so number of days per day purchase, you multiply it by the credit allowed by the suppliers. So per day purchase multiplied by the credit allowed, that gives you your credit balance. Absolutely, Varsha used a very correct statement. She said cost of goods sold is basically blocking your or rather with the debtors, it's your cost of goods sold which is being blocked. Perfect. Okay. Direct wages, they give you that, okay, how many number of like you pay the wages in 1 month, a year, or whatever. So I think you need not worry about these things. Estimated labor hours into wage rate per hour. You would be knowing the wages, and they will tell you that how many number of months in arrears. So let's say they give you the monthly wage. They give you the monthly wage, and they give you the okay that the company is paying wages 1 month in arrears. So what you will do is you will take the production, you will take the total wages, and you'll take that for 1 month. That's it. Overheads, other expenses, but mind you, does not include depreciation and amortization. So again, estimated overheads per day multiplied by, like for example, how much time you take to pay your electricity payments and so on. Let's say it's in 1 month a year. So let's say bill is generated next month and you pay in 20 days. So that's your 1 month a year, right? So left hand side talks about of current assets. Right hand side talks of current liabilities. And we calculate current assets minus current liabilities. We get to know what is my net working capital. But mind you, everyone is conservative. You guys agreed. Many companies would like to add a margin of safety. That will be given to you in the question. Let's say the company says that company wants to add 20% as a margin of safety. So whatever working capital you're calculating, you add 20% to it. That will be your working capital, guys. Everyone with me on this? So basically, you can see that as a summary that you have current assets by inventory. You have three types of inventories: raw material, work in progress. And mind you, many students find this work in progress slightly tricky. So that we'll discuss post break. Finished goods, receivables, minimum cash balance that is given to you generally. So then you get a gross working capital. Current liabilities where you will generally have your creditors, your wages and other overheads. And for me, this is important. Margin of safety. What amount of surplus you want to plan for your working capital requirements? And that is known as then your current assets minus current liabilities. Adding the margin give you net working capital required. Now, Yashika, I'm not sure which illustration you're talking about. We have some practice questions. We will be talking about that after the break. So probably that should solve your doubt. I'm not sure, but let's see after the break. So there is a very small point at the bottom, guys, which I will talk about probably a little later. Himanshu says 20% of what? Himanshu, whatever the net working capital you have calculated, right? So they will give you that this much margin of safety they need to add. So it could be 10%, 15%, 20%. So let's say my current assets is 3 lakhs, my current liabilities is 1 lakh. So 2 lakhs is my net working capital, 2 lakh ka 20%, so 240. So 20% of the excess of current assets over current liabilities. Okay, so guys, I think let's do one thing. This is almost 7:20 now. Let's take a break right now for 10 minutes. Let's come back and then we will understand this calculation with the help of an example. We'll talk about a proper question which entails the entire calculation of a working capital. And I hope, Yashika, your doubt with respect to WIP also will be discussed in detail. I don't know what is your exact doubt, but we'll talk about a working capital or WIP calculation specifically. So let's take a break right now, guys. See you in 10 minutes on the other side of the break. Great. Welcome back, guys. I hope everyone is back. Much needed break. I think it was a tremendous first half with all your participation. A lot of answers coming in from many students. You guys are proactively clearing your doubts, and that's what is taking advantage of these sessions. So before the break, we understood how do we calculate the working capital and the specific thoughts to be given to the elements of finished goods and debtors. But I can't forget Yashika's query, right? She said that, okay, a work in progress. How do we include or why do we consider work in progress? We'll talk about that. Now, before we go to the actual example, I would like to give you one more scenario. Can you look at the bottom of the slide here? Sometimes, and there is an illustration in your study module for this, we'll talk about that as well. Sometimes the organization may decide to work in double shifts. I think many people who have probably a business background or have your relatives having a factory, you know this, right? Many people have a double shift. That means you want to use your assets for greater efficiency. Now, in this case, of course, you would need additional working capital. But the most important point is that additional working capital may not be in double as proportion. Let's say if you are earlier producing 1,000 units, now you are producing 2,000 units for double shift. Let's say my earlier working capital was 50,000. With double shift, it may not be 1 lakh. Let's say it may be, let's say 76,000. But how do we calculate this? For that, we need to be very, very careful of, especially one thing, double shift will not have any impact on WIP. Why so? Because as soon as the second shift labor comes in, they will complete the first shift WIP, guys. Yes or no? Imagine the shift starts from 8 to 5 and the evening shift starts from 6 to 2 in the morning. Or 3 in the morning. So when we talk about this, or let's say there is no break, so 8 to 5 and probably 5 to 2. So there are two shifts. Any timings, guys, any timings. Some people may think, the factory starts at 6 a.m. in the morning. So you can have two shifts like 6 to 3 and probably 3 to 12. So that's okay. But the second shift guys who come in will complete the first shift WIP. Everyone agree with me on this? Everyone agreeing with me on this? So WIP at the end of the second shift would be probably same as was in the case of first shift. Assuming the same level of efficiency, mind you, there is no tiredness coming into picture because there are two different group of people, right? Guys, can I get a quick confirmation on the WIP point? Great. Thanks a lot. Don't worry, we will see that in one of the questions as well, right? So let's now, explore a good practical question here on the working capital calculation. On 1st January, Managing Director of Bhavani Limited is curious to know the amount of working capital that will be required, guys. Now, this is what I was talking about. You're estimating the working capital, right? That will be required. So you have to compute the working capital requirements forecast based on the following information. There's a lot of information given to you, and we have to do this one by one. So let's say, just give me 1 second. Probably work it together, and I want everyone to be participating. Varsha, we are not saying WIP period to be reduced, but what we are saying is that WIP will be the same amount. It will not double, right? So let's look at one by one, guys. We are looking at calculation of working capital. The first point is production during the previous year was 1,20,000 units. We know the production good. It is planned that this level of activity would be maintained. For me, look at the first point. Raw material are expected to remain in storage for an average of 2 months. And they're saying the expected ratios of the cost to selling price is raw material 60%, direct wage is 10%, and overhead is 20%. And right below, they're given you selling price as 5 per unit, right? That means raw material is 3 per unit. Direct wages is 0.5 per unit, and this is 1 per unit. So probably the total cost is 4.5. Rest is profit maybe. I hope everyone is doing good till this point. Now, if we know this, that okay, this is to be expected to be in store for 2 months, let's try to calculate the inventory. If we're calculating working capital together here, within working capital, we calculate inventory first. Inventory mein first I'm talking about raw material. How much is the how much is the number of units to be produced, guys? 120,000? 1,20,000? Himanshu, don't ask me that, please. Himanshu, profit bhi to hoga. Selling price minus cost is profit. So there are 1,20,000 units to be produced, for which the raw material cost is 3 per unit. And we are doing 2 by 12. How much is this? 60,000 worth raw material we need. That's given in the question. 2 months. Okay. Moving ahead. So I'm not even using any formulas here. I'm just applying the logics, right? They're saying that each unit is expected to be in process. We're looking at WIP. WIP is in process for 1 month. Raw material is fed into pipeline immediately. And the labor and overhead are accruing evenly during the month. I am slightly stuck at this point. WIP. We are looking at raw material, labor, and overhead. Everything is combined. WIP, guys, yes or no? So if I were to calculate WIP, within the WIP, there are 3 points. One is raw material. Raw material is fed immediately into the pipeline, and we are calculating WIP for 1 month. That's not that okay. That's okay, na? What you need to calculate is a working capital at the end of the day, whether you multiply it by number of months or number of days. If it was number of days, I would have calculated per day, right? So raw material is fed into pipeline immediately. So what I'm saying here is 1,20,000 into 3 into 1 by 12, guys. How many of you are with me on this? We're getting 30,000. Yashika, I'm not sure if your question was something similar. That why are we considering the raw material into WIP, or see, generally WIP is anyways the amount of units which are not yet complete. Uspe material lag chuka hai, there is a labor who has worked, and there is expenses on it, but that finished goods, that is not finished goods. So the raw material we talk about at the beginning was different. WIP is on a different units. So then we talk about labor and overhead, guys. I want everyone to be ultra careful right now. Labor and Bhumika, can you please check? I think raw material should be 60,000, guys. Can you please double check? It can't be 180. I've already multiplied by 3 and I've already talked about 2 by 12. Okay, what is the information for labor and overhead, guys? Labor and overhead costs are incurred during the period evenly. So guys, if this is my month, because WIP is for 1 month, right? WIP is for 1 month. And if there is a material that goes in on the first day, but when we go to the labor and overhead, it is incurred evenly throughout the month. So that means there will be some labor and overhead on second day, some on 20th day, some on 4th day, some on 26th day. Every day there is some kind of a expense being incurred, guys. Yes or no? Guys, everyone getting the point? Labor and overhead costs incurred of evenly throughout the year, throughout the month. Is everyone understanding the meaning of the word evenly throughout the month? Every day. That means if all the expenses are incurred every day, on a safer side, can we calculate the WIP right and the center here? Right at the center? Because some of the labor and overhead are incurred in the first half, some of the labor and overhead in the second half. So can we say that labor or overhead, which is 1.5, is for 0.5 months? I've taken half month. Can I get confirmation, guys? Bhumika, Kiran, Manchu, Yashika on all these points. I'm taking half month for labor and overhead here. So what is the amount we are getting at? I think 7,500 labor and overhead. Hence, my total WIP becomes 37,500. It's evenly throughout the year or the month, whatever the period is given. Because of that, the entire meaning changes. Kiran, just check. It should be 7,500. Now we are taking for half month. Half month. Now we move on to the next part, guys. Inventory mein, there is one more thing that needs to be done. We are looking at finished goods. Finished goods, for which we'll take cost of production or cash cost, whatever. I don't know if they have given any of the information for the depreciation though. Okay, finished goods will stay in the warehouse for awaiting dispatch to customers for almost 3 months. 3 months, guys. So 120 into 4.5 into 3 by 12. 3 months is how you will be calculating that. 120,000 into 4.5. We are getting 1,35,000. And hence, if we add up, what is my total inventory? 232,500. That's a total inventory, guys. Manisha, we have taken 0.5, not 9.5. First of all, because in the question you can see there is a term mentioned, labor and overhead costs are accrued evenly throughout the month. Evenly का मतलब है कि that they are incurred every day. So imagine first March को भी labor and overhead incur हो रहा है and even on 31st March. So how can you calculate for every day, right? So for some expenses it is 31 days, for some expenses it is 27 days, for some expenses it is 14 days, for some expenses it is 11 days. So we take an average for that because some of the expenses are incurred in the last 15 days, some of the expenses are incurred in the first 15 days. Now after this, we also have our debtors, right? Credit allowed to debtors is 3 months. I think debtors also will be having a similar requirement. That means, mind you, there is no profit here. Are we looking at debtors also as 1,35,000? Is everyone with me on this? this case, they are giving you cash in hand to an extent of 40,000. So let's include cash. $40,000. And I don't think there is any prepaid information. Any other current assets, guys? Not sure. So what will be my gross working capital or current assets? 232,500 plus 135 plus 40. I'm getting 4,07,500. Mind you, we are yet to calculate the current liabilities. So for current liabilities, we can use the creditors here, accounts payable. They're saying that the creditors allowed 2 months from the date of delivery of raw material here. So 120,000 into 3 into 2 by 12 is what your creditors is. 120,000 into 3. It's looking as a here. Everyone with me on this? And they're also talking about something on the wages and overheads. Wages and overhead are paid in the first of the each month for the previous month. So 1 month overlap for wages and overhead. So we say that expenses outstanding 120,000 into 1.5 into 1 month. How much are we getting this? 15,000. So hence my current liabilities are 75. So what you get as a result? My working capital. They have not given anything in the margin of safety, I guess. So they're in the absence of margin of safety, we are getting 332,500. I hope everyone is okay with this particular question now. I think WIP was a tricky one. Yashika, may I ask you specifically, was WIP doubt very similar to what we discussed? Like in WIP also we include raw material labor because that is a separate units being worked upon. See, raw material में जो raw material inventory will be the inventory which has not even started for production. सिर्फ raw material shape में है वो. Something which is in WIP which is already being worked upon. That's why you see raw material again in WIP. So there's a repetition going on here. Can everyone confirm, guys? All are with me on this? Thanks, Yashika, for confirming. So you guys can have a look at formal solution also. Now, after this, we are looking at a quick question here. Another one, and this is for you guys to calculate. They're giving you a lot of information. Sales at 2 months, materials consumed, wages paid, cash manufacturing expenses, and look at the brackets, guys. Sales 2 months credit, suppliers 2 months credit, wages 1 month in arrear, cash manufacturing expenses 1 month in arrear. Administrative expenses and sale promotion is also given, guys. Very important, these two might be. Because mind you, for the finished goods, you will say you will take as cost of production, I guess. But for debtors, you might take cost of sales. So make sure that you take care of this also, administrative and sales promotion as well. Varsha, no, raw material in WIP was given in the question. Huh? It was this is given in the question. Raw material being fed into the pipeline immediately. So WIP may raw material is for 1 month. Okay, so coming back to this one, so company sells its products on 25% profit. In money, they've given you sales, so be careful. And depreciation is considered as a part of cost of production. That's okay. It keeps 1 month stock of raw material and finished goods, cash balance of 50,000. And look at the end, assuming a 20% safety margin, calculate the working capital. And you guys have a smile on your face when you see the last line, ignore work in progress. I think that's where you talk about a smile on your face, right? Okay, that complicated thing is right now not there, but yeah, it's not complicated. It's just you have to be extra careful to calculate the WIP. Yes, Varsha. So, guys, can I request you guys to give me the answers for this one at least? We guys can probably do it together though. So what's going to be raw material here? Inventory raw material. What's going to be raw material, guys? They want to keep 1 month of raw material, right? And what is material consumed? 450 into 1 by 12. Is that what you're looking at? Raw material? Are we looking at a 37,500? That means so raw material inventory. Everyone will be on this. Finished goods. I think finished goods for 1 month also. We are looking at finished goods also for 1 month. Now, in the finished goods, we have to record a cost of production, I guess. So if we look at finished goods, we are looking at material, labor, and also overheads. So that means if I combine these three, Bhumika says in all questions WIP. Obviously, Bhumika in what is WIP now? Work in progress. Unless they give you a very strange process in which material is not yet introduced, like you discuss in costing, process costing, that's an exception. But otherwise, WIP means everything would be in, right? Darshan will come to admin and selling now. But right now, I want an answer for the finished goods. 450 plus 360 is 810 plus 480. I'm getting 12,90,000. And 12,90,000 divided by 12. So this is my total cost of production, 12,90,000. That 1 by 12 should give me finished goods of 1,500. I thought you guys are giving me the answer for this one though. So I want you guys to be ahead of me. These are two inventory numbers. Who will tell me the debtors, guys? Who will tell me debtors? I will wait for the answer for debtors from you guys. In the meantime, let me just quickly check my own. And debtors are at 2 months credit, right? I'm waiting for debtors answers from everyone. So I'm getting a couple of answers. Kiran says 245, Himanshu says 225. Mind you, for debtors, we probably are looking at cost of sales. Swati Bhumika says 3 lakhs. Amazing. Because what will be including in the cost of sales? I probably feel that apart from 12,90,000, you should also include administrative and sales promotion. So that means it is 14,70,000. into 2 by 12, which gives me 2,45,000 guys. I think a couple of you got it correct. Kiran, absolutely perfect. Himanshu, I think you did some small error. Varsha, Komal, Swati, everyone good now? Oh, bhaiya, don't include sales, please. I think some of you are including sales. Some people did 18 lakhs into 2 by 12. No, sales include profit. So we add up all the cost. We get 14 lakh 70,000. We get 14 lakh 70,000. Everyone okay, guys? Debtors okay, 2 lakh 45. And I think prepaid expenses. We have a prepaids. We have in advance sales proportion expenses is paid quarterly in advance. So probably we are looking at 60,000 prepaid in a quarterly. That means we are looking at 15,000. Himanshu say reverse from sales. Okay, no. So Himanshu, when they are giving you all the costs, you don't need to do that, because that is a gross profit anyways. So you don't know, what has been included in the other cost. So 15,000 is prepaid. Cash is given to us. 50,000. So what is my total gross working capital? I think 455 is what I'm getting. 455. Now we also need to calculate what is my current liabilities, guys. Current liabilities may we have creditors. So creditors may we are looking at. Okay, this could be interesting. Creditors would be like 450 into 2 by 12. 75,000 guys. Everyone with me on this? Is everyone getting 75,000? And then we have expenses outstanding. How much is the, okay, Bhumika says, please explain, and Varsha also. Guys, I've included all the expenses, boss. Materials, wages, cash manufacturing, administrative and sales promotion. Add them up. You should get a 14 lakh 70,000. I've added all the expenses. Okay, so there are some expenses which are paid in 1 month arrear. Wages, 3 lakh 60,000. Manufacturing expenses, 4 lakh 80. And administrative expenses, 120. So total 9 lakh 60,000 expenses are paid 1 month in arrear. 960. Hence, we are looking at 80,000. So total current liability is 155. Bhumika, Varsha, I hope you're clear. So how do we calculate working capital, guys? Current assets is 455 minus current liability 155. We're getting 3 lakhs. So that's not our working capital, maybe. I think there is one more additional zero, so let me get rid of that. So we're getting 3 lakhs. And we add a 20% margin here, 20% margin of safety. Someone was asking me on what, so we'll apply 20% of this 3 lakhs, we'll get 60,000, and hence we are getting 3 lakh 60,000 as an answer. Darshan, absolutely amazing. So Darshan gave the correct answer anyways. So you guys can have a look at the fair working. Hmm. Okay, so now guys, with the almost half an hour to go. Okay, first of all, let me just confirm. Any doubts on this question? Any doubts on this question, guys? Can you please confirm? With almost half an hour to go, I would like to punch in to the last question of the day, which will take some time. I would like request everyone to be kind of, getting all the concentration collated. Some of you might be feeling tired, but my request is that this is important. This question from your module as well, submarine enterprises. We talk about double shift here. Now I'm giving you a solution and a homework, guys. This question, I believe in your module is solved in two ways, right? The company has decided to work in double shift. One is as part of the policy decision, they are working on double shift permanently. And another way to look at it is that you are probably doing the double shift just one time. Now we are not discussing one time here, that you can do later on, that you can check later on, because the question in the last line says policy to increase the output is implemented. So we will only solve in the class as part of the policy implementation. So this question is very important. I request everyone to be extra careful. And while talking about each of the element, we will talk about the solution as well. So Submarine Enterprises has been operating its facilities on a single shift with following cost structure. Single shift, this is cost structure is given. 6 is the cost of material. Stock of raw material is 36,000. So how much in units? Maybe 6,000 units, I guess. Wages, out of which 40% is fixed. So variable would be 3 and fixed would be 2. Overheads, 20% is variable 1, fixed is 4. Profit is 2 and selling price. Like giving you the selling sales during 1670 is 4,32,000. So that divided by 18 is how much? I think I'm getting 24,000 units in the single shift. Guys, everyone okay with the table right now? Work in progress is valued at prime cost. What is prime cost? Material plus labor. So that means 11. Hence, we are looking at 2,000 units. Finished goods valued at total cost. What is my total cost? I think total cost looks to be 16, right? So 72,000 divided by 16, giving 4,500 units. I hope till now everyone is okay. I'm just analyzing the given information, nothing else. And that's what most of you do, right? When you are looking at a complex question, you analyze the information, you try to do whatever you can. That's what everyone does. Now, in this case, very important point you need to be careful about is a work in progress. Mind you, 2,000 units, that will be important. In view of the increased demand, it is proposed to double the production by working an extra shift. How much you are planning to make the production, guys? From 24,000, we are looking at 48,000 units. It is expected that 10% discount will be available from suppliers of raw materials. That is amazing. So raw material instead of 6 per unit will be costing us 5.4 per unit. Yes or no? From 6, it will be 5.4 if we operate at that level, guys. I think everyone understands this point that you buy in bulk, you get a discount, right? That's what we all know. And that's what even we bargain on a day-to-day basis. Just checking the query platform simultaneously. Anyone wants to ask anything or everyone doing good till now? We're just doing some kind of a brainstorming exercise with a question here. Okay, so selling price will remain the same. Very good. That means our profit will increase. The credit period allowed to customers will remain unaltered. Wow. So we are looking at a 4,32,000 sales and debtors of 1,08,000. How much is the credit period we are looking at right now? Any thoughts? How much is the credit period we are looking at? So let me check with everyone. I want your responses on this. Credit period doesn't change, right? So what's the credit period right now? We look at Sunday debtors of 1,08,000. But Sunday debtors probably are at 18 per unit, guys. Am I correct? Darshan says 3 months. So what I think Darshan you are doing is you're saying 4,32,000 divided by 1,08,000. That's what you did, or something else. Someone at 2, someone says 90 days. Okay, hold on for that. We will talk about that a little later. What is the amount of the credit period for debtors? Mind you, this will be a very, very important discussion. So you're given the sales, Sunday debtors, but mind you, this debtors could be at 18 per unit, right? So we'll also look at what is the amount of debtors or working capital. But right now we feel that 432 divided by 108 looks to be 4. So 1/4 of debtors are due. So we say that 1/4 of the debtors are due. I think let me put it other way around so that you guys are not confused. Let me say this is 1,08,000 out of 4,32,000. Hence 1/4 means it will be 3 months. We will use this information later, guys. 1/4 of 12 months would be 3 months, right? Okay. So the credit period allowed, the customers will remain unchanged. Credit availed from the suppliers remain same 2 months. And lag in payments of wages and expenses will remain half a month. We have to prepare additional working capital requirements if policy to increase output is implemented. Guys, we are implementing the policy. We're changing our manufacturing style from a single shift, double shift permanently, not as per part of just meeting one-time demand. That's another way of looking at this, but that is not requirement of question. That's why I've not covered it here. Now, I want everyone to be very, very careful right now to understand one aspect. And the aspect is, can we see a lot of fixed cost also? In wages, there is something fixed. There is overhead, there is something fixed. Will the fixed cost change with respect to volume? Yes or no? Will the fixed cost change because of volume? Unless there is a capacity constraint, that's a different ballgame. But will it change? Will the fixed cost change? So that means I probably have to calculate this fixed cost at 24,000 units. So let's say wages as an example. What is fixed wages right now? 2 into 24. 48,000. If 48,000 is fixed, then probably for 48,000 units, it will be 1 per unit, guys, not 2 per unit. It will be 1 per unit. Fix will not change. Total fix will not change, but per unit fix will go down. Total fix will not change, but per unit will change, right? Absolutely, Varsha. Average fixed cost will go down because my volume is increasing, guys. If my volume is increasing, my per unit variable cost, there will be no change. Per unit fixed cost will go down. And that's what you bargain, right? When you increase, you purchase more quantity, you bargain with a better price. So let's look at this together, guys. So sales for 2016-17, this is what we discussed. Present volume is 24,000 for single shift. What we are looking for is a 48,000. Closing stock of raw material, I told you this is for 6,000 units. But for me, the most important point becomes your work in progress. Work in progress is 22,000 valued at prime cost, which is material and labor. So this 2,000 units shall remain 2,000, whether it is single shift or double shift. It will not change. Because what will happen is second shift wale labor will come. The second shift labor will come. They will complete those units and they will continue the production. So at the end of the second shift, probably the same number of units will be in progress. Guys, all okay? Everyone okay till now? So WIP units will not change. Now we also calculate finished goods stock, right? Finished goods was 72,000 divided by 1645 units. So this is also we calculated. But what I need you to understand is now what is the impact on the cost because of the efficiency or economies of scale. The fixed cost total level pay is not changing. That means fixed cost per unit will go down. That means raw material may there is a change because of the discount, guys. Raw material there is a change because of the discount per unit 6 to 5.4. So 48,000 ke liye amount will be different now. Total level pay for 48,000. So 48,000 into 5.4. My total cost becomes 259,200. Now what we have done is wages we have split into variable and fixed. So variable remains 3 per unit, so that will double up. But look at my fixed wages. We calculated this, right? From 2 to 1. Your fixed wages is remaining same at total level. 48,000 remains 48,000, but per unit goes down. Similarly, in the question, they have given you overheads. 1 is variable and 4 is fixed. So that 4 fixed is giving you 96,000, which remains 96,000. The overheads. Fixed overheads remain 96,000. So per unit is half now from 4 to 2, but variable overhead gets doubled from 24 to 48. So variable cost are doubled here because the production is doubled. Bhumika, what we are saying is in WIP now. I think your question is WIP. So let's say when the first shift goes home, there are 2,000 units in progress. So Bhumika, when the second shift workers will come, will they start new units or they will complete those 2,000 units first? I think they will resume from where the other guys left. And if that is the case, then of course at the end of the second shift also you will have same volume. Assuming the consistency of the operations. I hope everyone is okay here. See, what I'm getting here is because of the single shift, double shift economies of scale, my total cost is gone down from 16 to 12.4. Why? Because my fixed cost per unit went down. Total cost has gone down from 16 to 12.4. Hence, profit has gone up. And hence, we can say the working capital requirements will not double. Will not double, guys, because my cost is not doubling up here. Everyone okay? Understood the concept here? I will give you 1 minute to digest this and ask me any questions. Everyone okay here? Let me know any doubts, guys. I'm just looking at the query panels. Let me know if all is clear till now. Great. Thanks, Darshan. Amazing. Let's move to the actual calculation of working capital now based on this cost sheet, guys. Very important. This cost sheet on the previous slide will seed the input to the actual working capital calculation. Mind you, let me write it down here. We are looking at 24,000 units. And in double shift made, we are looking at 48,000 units. Raw material remains same. I think very, very important that we understand what is the raw material requirement. I think raw material requirement was 6,000, so it will develop, I guess. Raw material 6,000 chahiye the. Now you will be needing 12,000, yes or no? So raw material is 6,000. Now the units will change 12,000. But since it is at a discount, it is at 5.4 and not at per 6. So it's not doubling up. So it's not 36 to 72. No. There is a discount. 72 minus 10%. So we are calculating the working capital one by one. Anandu, we have already calculated na per unit cost for double. For double shift, we have calculated the per unit cost 12.4. That is what we'll do now. Okay, let's move to the work in progress, guys. This is the important point. Work in progress, I told you 2000 will remain 2000. The only thing, since it is mentioned at prime cost, we are using 11 here. But as a revised element, we are not using 11. What is my prime cost now? Material plus labor. 5.4 plus 3 plus 1. 5.4 plus 3 plus 1. Because my fixed labor would have gone down. This will give you 9.4. So my working capital, or sorry, work in progress, WIP, is 2000 units, but the cost is less now. Cost is reduced. It is not 2000 into 11, it is 2000 into 9.54. I want everyone to be pretty careful. We are using the double shift numbers per unit now, 5.4, 3 and 1, material and labor. Okay, so 18,800 we get. Finished goods may we have 4,500. Of course, with a double shift, we are looking from 4,500 to 9,000. But what is my total cost, guys? Earlier it was 16 and now it is 12.4. I already explained you this in the last slide. 16 say 12.4. So 12.4 into 9,000. That's my finished goods. Now here, debtors. I think debtors may be what we discussed earlier, that we're looking at 1,08,000. There are two ways to understand debtors here. We say 1,08,000 divided by 18 is 6,000 here. But we learned 3 months, right? Did we learn 3 months? I think we learned 3 months. So look at debtors. One way to look at is 1,08,000 was my sales. 18 was my selling price. So single shift mein 6,000. But for double shift, it will be 12,000. Another way to look at is 3 months, which we calculated. So 3 months means 24,000 into 3 by 12 is 6,000 and 48,000 into 3 by 12 is 12,000. Hence we get 12,000 for debtors. Hence we get 12,000 for debtors. And we are using the same amount cost per unit, cash cost per unit for finished goods and debtors here in the absence of any other information. 12.4, 12.4. So that brings us to the total current assets or gross working capital. I want everyone to, let's say, just relook at the working for 1 minute. If you are comfortable, just confirm me on the query panel. Is everything smooth now? All okay till gross working capital. Couple of students confirmed. Great. Darshan, Bhumika. Okay, moving on to the current liabilities now. What was happening for materials, guys? I think materials, they mentioned 2 months, right? 2 months will remain same. It's right there in the question at the bottom. 2 months. So 2 months means 2 by 12 of 24,000. That is 4. And that means it gets doubled for 8,000. And since the discounted price is there, 5.4. So 24 is not going to 48. Rather 48 pay, we are getting 10% off. 43,200. That was materials. We go to other expenses now, wages and other expenses. So in the question they have given us, the wages and expenses will continue to remain a half month, guys. Half month. So what is my wages requirement in the existing scenario? Half month. So 24,000 into 0.5 by 12. That's why we get 1,000 here. Whereas for 48,000, it will double up 2,000. So creditor for wages is for 2,000 units, but mind you, at a reduced per unit cost. Fixed cost come over. So instead of 5, you are including 4 now. Look at the wages. From 5, it got down to 4. Total wages per unit. So 2,000 into 4, 8,000. Similarly, for expenses, we are using the same 1,000 and 2,000 units. But the expenses which were overheads, which were total 5, 1 plus 4 are now 3. 1 plus 2, 3. So overheads are no longer 5. So look at these savings, guys. These are operational savings, right? My credit for expenses are not doubling to 5 to 10, but it is going to 5 to only 6,000. Hence, what we are looking at is a total current liabilities of 57,200 and working capital is 3,44,000 minus 57,200, which gives you 286. Mind you, the most important point is in single shift. What we did was 192,000 was working capital. When we are talking about double shift here, imagine you would have thought that, okay, my requirement would be 198,000, 192,000 into 2. Anyone would think that, okay, my requirement will change. That is the case. Am I looking at 384? Absolutely not. We are not looking at 384 here, guys. We are saving a huge amount. So in terms of operational efficiencies, if I say 286,800 divided by 192, it is giving me 1.49 times. So the shift is double, but it is 1.49 times. So almost 1.5 times. This is operational efficiency for you, advantage of working in double shift. Guys, everyone okay with the example here? Any questions unanswered till now? I hope all the queries are taken care of. Let me know, please. Kiran, Bhumika, Yashika, Muskan, Anandu, anything you want to ask, Said? It's a good question, I would say. It's kind of summarizing the working capital calculation in a classic manner. How many of you enjoyed this question, by the way? I'm sure some people might have thought that, okay, hey, it's kind of a slightly tricky question. but some of you might have enjoyed working around this. I know with the 2.5 hour session, this question being at the last. Okay, Yashika says, how did I calculate 1.49? Yashika, I just divided. Okay, let me just check. 286 800 divided by 192. 1.49. No? Yashika, I just calculated 286 800 divided by 192. So with the double shift, my working capital is hardly slightly less than 1.5 times. So additional working capital is 192 nahi hai, it is 94 800 only. This is what they're saying at the bottom as well. Varsha says she enjoyed it. Thanks, Varsha. Sir, entire solution is clear, but at what rate fixed cost is changing? Bhumika, for that you need to understand this sheet also, na? See, total fixed cost remains same. Total fixed cost remains same. So per unit will be total fixed cost divided by the new volume. So there is no fixed rate. It depends on whatever the volume you are increasing. See, with the volume changing, if you guys again asking me that question, with the volume, the total fixed cost doesn't change. Whereas the fixed cost per unit may go down, as I mentioned earlier, if the volume increases. Bhumika, I hope that's clear. Darshan says loaded with a lot of concepts today and we will learn this part. Yes, definitely, Darshan. I want you guys to go back and Darshan, don't worry. Even if you have any doubts on working capital, we'll come back to the working capital practice later on. What we'll do is we'll stop here. We will stop here because we will be starting with the individual components of the working capital management. Probably starting with the treasury management, which you can see on your screens. And we'll target to cover some components on Friday. And then Monday, we will wrap it up the entire session with some practice. I hope everyone understands the plan. So make sure that you guys do your work. Study the initial section of the working capital, what we learned today, what is working capital, what are the different policies, the liquidity and profitability trade-off. We calculated the operating cycle, we calculated the working capital, we understood the working within the working capital, we understood the significance of WIP. We talk about double shift. We also talked about margin of safety. So a lot of learning, I'm sure, for the day, but I'm sure you guys enjoyed the session. So I thank you all for joining in. I'm pretty sure that we'll have a lot more fun on Friday. We'll continue to have a lot more fun throughout our sessions as we have had in the past. So thanks a lot, guys. It was wonderful from you guys. All the participation I can see that it is amazingly great. Bunch of students who are really working hard towards your objective, and I wish you all the best. Continue with that approach, and I'm sure you guys will do good in life. So thanks a lot, guys. See you all on Friday in a couple of days, and continue with working capital management. Till then, please be safe, continue to work hard, and have a good evening, guys. Take care. Cheers.